Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 27th, 2019. I did a video yesterday. However, that one I had to cut out yesterday afternoon. I mentioned I'd be gone in the last hour of trading and not getting back till after the close. So I put out a video. It was premium content because we covered Bitcoin, crude oil, nat gas, gold, you name it, along with the broad market. So this one will be somewhat of a recap to that video, although we do have some things worth noting today. So I want to get this one out there as general market analysis, public content, and get this wrapped up as quick as possible. All right, so the from the bigger picture, not the longest term charts, but the daily charts. Again, this is that very significant level. Those three reaction highs after the correction started. You had the initial wave down last fall, and then you had this trading range it's set up right here, and that's the top of the trading range with three distinct reaction highs. And again, that was my maximum upside bounce target for the rally coming in as we headed into the end of the year, and so far that's where we've stopped. Now, what's happened is you had the other day on what was it Monday, we had a gap up. So I laid out a scenario in a very objective, high probability, or I should say a very objective shorting opportunity with an attractive risk reward, a very attractive risk reward, and that is the potential island top. Now, island top patterns come when you have a first and foremost, and this is probably one of the most important thing. I think a lot of traders force patterns or look for patterns when they don't fit, such as inverse head and shoulders bottoming patterns or head and shoulders topping patterns, or in this case, an island top or an island cluster top pattern. They're reversal patterns. They come after an extended, prolonged uptrend, like this. This is where you want to look for them. Not here, not here, not here. Anywhere in the middle of a trend or early on in a trend after a reversal. Any gaps there are breakaway gaps, or they're in the middle, they're called continuation gaps. You get exhaustion gaps towards the end. Now what happened, and I did post an update on the site right after the market opened. We gapped down, putting in gaps on both sides of QQQ and SPY, but I made mention that, look, this market doesn't do easy. There's a good shot. You'll see the algos, pop the stops. I'm referring to those that shorted the gap down yesterday. So I said, be prepared or expected to see them pop the markets back up, maybe to the midpoint or so of yesterday's candles. And that's what they did. You can see where we closed. But on SPY, we still closed. The body of the candle was closed above the previous one. So I wanted to point that out. And I did point that out yesterday morning. I said that, these wouldn't be, if so, they wouldn't be textbook, quote unquote, island tops, because you're not separated by gaps on both sides. However, for all intents and purposes, and it really doesn't matter because the shorting op comes in the morning. That's my strategy when I see a potential island top. And not just because you have a gap and then look for the next gap down. It aligns with everything else I've been covering recently, everything on the 60-minute charts, this, key long-term resistance, the overbought conditions, the bullish sentiment, et cetera, et cetera, et cetera. So therefore, that was an objective shorting op yesterday. And again, most importantly, at least the way I trade it and I shared it is you just set a stop above the previous candle. And at that point, from yesterday's gap down, you're talking about a 0.5% or so, maybe just a hair over 0.5% loss if stopped out. So look at it this way. If the market pulls back just 2%, you make 2% on pullback trade, that's a 4-to-1. If that's what you're targeting, that is, there's a 4-to-1 risk reward ratio. That's very attractive. And this is where I wanted to talk on real quick before we get into the short-term charts. If, and that's a big if the scenario that I've laid out, which I still think is a possibility, that we need more evidence, but the scenario that this was the first leg down in a new bear market, a much larger bear market than what we saw here, or call that a correction, which I'm referring to. My downside is well over 20% from here. So where I'm going with this, there's really for the most part, there's two schools of thought right now on the market. Everything that I've read and heard and seen, the vast majority are in the camp that the rally off the lows on the 24th was just too strong. Breadth was too good for whatever other reasons. that camp, which again I believe is the vast majority, believes this market will go to new highs because of that. They don't. I think even the most ardent bull is looking for at least a correction to buy, maybe wait, not add at this point, so overbought, extended. But that's the scenario they're looking for. So I think where I'm going with this is right now, your views, they are important. I sometimes hear traders say, "Oh, I just trade the charts. I don't have an opinion. I don't have a bias." That to me, that's hogwash. If you have a strategy, a methodology or something, and you stick with that, I get it. But you have to be adaptive in different markets. Trend trading works great in a trend like this. Trend traders that have the signals that keep them in here would have got whipped. When they probably would have gotten out too late here, you would have got whipped to death here. You can't trend trade, use certain trend indicators on certain markets. They work well on some, and they don't work well on others. So personally, I have a more flexible trading style. But where I'm going with this is if you do believe that there's a good shot, even if that shot, let's just say it's less than 50% chance, but somewhere close to that range. So you shorted yesterday. You had a stop loss that wasn't much more than 0.5% because it was above yesterday's highs. You know, my next downside targets, I don't have them right up in front of me right now, but they're somewhere south of 20%, well over 20, maybe even 25% from where we are right now. And so that would be a 50 to 1 risk reward. Very few do that, but I want to make mention that if that's your strategy, your plan, even if it's on a small position, that's the thing too. Any shorts now are still counter trend trades. No reason to go loading the boat, and there's still not overwhelming evidence that this was a bear market rally. That it's not just a correction, or this wasn't just a correction. We're not going to new highs. I've talked about the long-term case. Some things clearly signaling long-term trend indicators rolling over or key support levels broken, whereas other indexes and indicators haven't yet. So we're still at that what I call a question mark phase. Could go either way. I haven't wavered on my expectation, and I still put better than 50%, not 100, not even 90, but up there, probably 70% or more. That this is the scenario here, that this was a bear market rally. So I wanted to point that out, and this is where you need to decide then if you are of the mindset that this was a great buying opportunity on the road to new highs. Then you want to look to position long on these pullbacks. If you're a very flexible trader, you're not a bull or a bear, you are just truly, market agnostic, trading the charts, then you probably want to be short here, come in and identify your targets, whatever they are. I'm not going to give specific targets because we're probably going to add some new short trades back onto the site here, and this may be one of them. But let's just say somewhere in this range. And you can see we have a lot of support levels below the 200 and the 50. So this is where dip buyers, you can see a very nice level right there, just shy of the 50 and 200 day as they're turning back up, poised to cross. They haven't done so yet. There's still that death cross back here. The 50 crossing below the 200 is still in play, and that is a trend indicator. That's a trend indicator that if again, it's one of many things that go into my analysis, but this has been a pretty reliable trend indicator in the past. When the 50 is trading below the 200, you're in a bearish trend or a bear market. But those levels also are significant, and so you'll almost certainly see somewhere around this level if we get there. I'd be surprised if we didn't pull back that much, but if we get there, you should see a wave of buyers step in, and that's where the dip buyers should buy. So now here's where I'm going with this. So this is what you want to watch. You can put up key Fibonacci retracement levels. You can identify support levels, trend lines, other things, and look to see where the dip should be bought. And again, if that's your mindset, then you want to do that. If you think the market's going lower, well, you may look to add to a position, maybe a starter short position here, if those levels start to break. And that will be, so the next, once we have the next decent correction, whether it started today or yesterday, which I believe it did, or not, the next big correction will tell the character of this market. You'll see how the dips are bought up. There are levels that should hold and contain a pullback. Again, typical, Fibonacci retracement levels, key moving averages, trend lines, everything else. If they're broken, this is my expectation. If and as each of those levels are broken, and of course there's not just one level. There is not okay, bullish above this line, bearish below this line. That doesn't exist. It's more of a range. And so if and as we start to move down below that range, I believe what will happen is there's going to be some, certainly some volatility and some dips being bought here. And if the market's going to new highs, they're going to get bought up pretty quick. And then the more aggressively they get bought up, and I'm talking bought up and then punch back above today or yesterday's highs, take out that key level I showed you a minute ago on SPY, that would be very bullish. But if we come back down, there's a point here, and I referred to it back here too. I'll call it the point of recognition, where dip buyers, those bullish, thinking the market's going to go to new highs, it'll be that WTF moment where they realize, okay, wait a minute, something's wrong. This dip should have got bought up, it didn't. This pullback to support here should have been bought up, and it didn't. So what I believe will happen, and this is also part of the pattern of a bear market. If that is what is going on here, if this was wave one down, wave two up, you will start to see waterfall type selling come in here. And the closer you get to those lows, I think by the time you even get remotely close to those lows, if we get there on the 24th, you'll probably already see it going on. I don't think you're not going to limp down to a back test of these lows, with something, like this, a very orderly, gradual sell-off that takes, months towards the end of the year. Look, is it possible? It's certainly possible. I'm just laying out what I think is the most probable or likely scenario. If some of these levels here, let's just say the midpoint, let's keep it very simple. I'll throw up a Fibonacci for you. Let's just say, all right, here's the rally off the lows. Here's your 50%. And that's the number I was looking at. So let's just call that. If you want a line in the sand, at the risk of using that number, I said you really shouldn't have a line in the sand number. That would be it. I think if we go much below a 50% retracement, which is about, 170 or 159 or so on QQQ, that would be that WTF moment. And then you don't want to be long and you want to be short. Okay, getting very much ahead of myself, but before we move on to the intraday charts, a couple other things to point out here on the daily chart. At least one other thing, and that would be, again, this very high, I like to see this clean separation on the PPO lines. I like to use the PPO, especially on a daily time frame. It does a better job than the MACD, gives you a little bit of separation and just better peaks. Just my preferred indicator. And you get down to a shorter term chart, you can use a MACD. They're going to marry each other. But you can see that high level bearish PPO crossover coupled with overbought conditions. What I mean by bearish PPO crossover, well, and I've covered this in recent videos, put up a MACD histogram. And when you're in a trending market with low volatility, a low grinding market, whether it's sideways or up, same story, there's not any correction. There weren't any real true corrective waves in this move up here. So what happens, you stay away from trend indicators such as things like PPO crossovers and things like that and moving average pairs, because they'll just whip you to pieces. You don't really have clear trends. It's these trends like this is when you want to use it. These clear trends, there's a tradable market there. And when volatility spikes. So and again, something I covered. I like to look for what I call hills in the histogram. In the PPO histogram is just a visual representation of the distance between the two lines. So the higher these bars here or the lower they are, the farther the two lines are apart. And so once they cross the zero line, when it goes from green to red, you have a bearish PPO crossover. And I like these big, what I call hills. The bigger the hill, the better it is. That's showing you that there has been a very strong, clear trend, which we know off the 24th. For example, here was a nice hill, bigger than the rest. there was your crossover right there. It came, boom, told you this trend was over. That was a sell signal, not a standalone. I don't use any one thing. I put a higher weighting on trend line breaks and things like that, but these are confirming signals. And they also help give you the scope of the move. Bigger the hill, usually the bigger the move. So look at the correction you had. Right here, bullish cross, and there was some upside to go. You had another nice hill, bearish crossover, boom. And there's a big hill right there, a very big hill. You got a crossover here, someone came somewhere there, a nice little correction. And again, the market was still in an uptrend, and then that volatility started to abate. And so you had some whippy signals here, but there's a big hill. There's a crossover. Yeah, we had a big hill here. There was a crossover right there. And now, so the point is, this is a very clean hill. And you can see, again, I've talked about it, momentum has been waning. That's why you're seeing these lower peaks on the PPO histogram. And now you have, if you zoom in really close, you see we finally have that daily crossover there. First bearish crossover. It's not official yet. This is a daily chart. You have to see it close red. Anything can happen. We whip back up today, have a strong close on the green side, then we're not going to get the signal, but I'll tell you what. You can see these hills when momentum begins to wane and you're making these lower highs. Eventually, you're going to get a crossover. Sometimes you'll come down, test the zero line and bounce. This one didn't quite hit the zero line. There was your cross. And based on this, I'm probably going to get that crossover now and some more downside. 60-minute chart, SPY, there's that wedge, trend line off the 27th, reaction low. I think it's safe to say this one's broken, and by pretty much all accounts, I still, like I said in the recent videos, I would, be nice to see last Thursday's reaction low get taken out. I think at that point you'll start to see more impulsive selling come in. There's also some support there, so I'll give you that line. That line comes in at about 276.30. So I think once they take that out, maybe a little, you can see there's some gaps below, give or take. That should open the doors to some more downside. That's also a minimum pullback target. I mean, if you're very bullish right now and looking to just buy, what would that be off the top? You're looking to buy dips, and if we get there, you're talking about almost a 2% drop, a little shy of that. If that's your thing, I can tell you that's support, but that's a support level. And again, it comes back to the mindset of what are your expectations? I always say this, that you need to have an opinion on the market, because TA 101 says you do one of two things when you identify a support level. You either look to position long because you expect a reversal, or you don't do that, but you wait for a break to position or add to a short if you think there's more downside. And again, based on everything here, and as well as a daily chart, that's what I think will happen. So it might look something like this, maybe a little pop there, or maybe not. I wouldn't early on in a breakdown after a rising wedge like this. I don't try to game. I don't get cute and try to game the pullbacks. Maybe in an active trading, day trading account, if I'm, and that's a whole other thing. This is swing trading, but on a 5-minute chart, 15-minute chart, even a 1-minute chart, if I can game a quarter point pullback on a few contracts NQ, well, it's worth the trade. Put $1,000 in your pocket or close to it. You don't need to make a whole lot, but that's day trading. Swing trading, watch that level, and I can tell you there's some targets down here. Again, I'll have to zero in on the targets, and we may make some of these official trades. So let's look at QQQ. There's QQQ. There's the trend line off the 27th. Breakdown, back test. So far, that's all that was. But again, we need to take out these lows right here, and that should really open the door for some nice selling and increase the odds that a swing trade will play out for more than just a percent or two. So there's the breakdown, back test of the wedge. The divergence stayed very much intact. As I mentioned before, divergence lines are not, this is what's significant as far as a buy or sell signal. Divergence lines are just, they're dynamic. As long as you're in an uptrend, they can continue to move higher. The divergences can continue to extend unless they're taken out. So we have the divergence, we have the back test. So check, check, check across the board. Let's see if this time we're good. We're better than a 3% pullback. Okay, and quickly we'll look at the futures. This is the NQ Nasdaq 100 E-mini futures. There's your trend line. It's obviously looks very similar to QQQ. You had the breakdown in the last couple updates. I covered this minor trend line here. You had this minor uptrend, stating we need to see that go. That formed a very small wedge there. That we broke down, little kickback rally, and then in yesterday's video, again that was for members only. I mentioned here's your sell signals to come. Again, we were somewhere in here. You want to see a break below yesterday's reaction low and then below Thursday's low. So far, checkbox number one, we've just taken out yesterday's reaction low, and this is checkbox number two. If and when that goes, and you can see, I'm not even interested in covering NQ short to at least this target here. There's whatever that is, 68.56, I think. That's where that's where that line is. And these are some other potential targets again for futures. The ES, the S&P 500 E-mini futures, you have it just that nice clean wedge again off the 27th, the reaction low. There's your big wedge where prices were pinching as the markets were losing momentum. And let's zoom in real close and see what's happened then. Since yesterday, we did take out. There's that reaction low that I said needed to get taken out. So now that's been taken out. And as expected, we didn't just limp down through there. We took it out, and there's an impulsive move down. So here's your next, what I think to be an important reaction low. And you can see some targets down below. I might have, I don't know where this line came from. That one needs to be moved. I'll have to refine this chart and give some targets, well, somewhere about there, 27.33. And you know what, there's also some, well, I already covered that. That's that reaction low from Friday. So that's a pretty important support level. That's one to watch right there. And again, dip buyers, looking to buy a shallow dip, I can tell you that's pretty decent support right there. And those that are shorting the market or looking to buy a deeper pullback, then I can show you another level right here. I'll have to put up some Fibonacci's on this chart as well, and I'll do that later on to try to zero in on some targets. But you can see, so let's just say these first three white lines right now as potential pullback targets on SPY or ES. And again, if you start to see these levels go, especially with very muted reactions off those, you get a little bounce or you just go on right through it like it's not even there. That's when you start to see, I've traded enough bear markets and corrections over the years to tell you that's when you're in a corrective phase or bear market, when you have the indexes fall to a well-watched support level, fib retracement levels, and then it slices through that level like it's not even there. That's what you want to look for to see the possibility to open up the door for that, waterfall type selling that will undercut the lows from December. But again, first things first, we have to get a correction of more than 3-4% here, which we haven't seen in quite a while. So let's just wrap it up here. Let's just see how things go in the next couple of days. Let's watch those near-term levels, and then we'll kind of assess this move if we get a move to the downside as it goes, and if not, if we go and take out the recent highs with conviction and clearly put those levels in the rearview mirror, then something else is going on here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.